Your reaction there to what we heard from Larry Summers as we continue to see the Fed really try to pinpoint when we've reached peak inflation and how to fight it.
Well, good morning, Juliet, and it's so good to be back in the studio.
Yeah, indeed.
Mr. Summers is probably right. The neutral rate is actually very hard to calculate, and it moves. And in higher inflation periods, it will be higher. So what's really important here is not so much the neutral rate. It's going to be financial conditions overall, and that's what the Fed's going to be looking at. So they're going to be, and in fact, that's what they're going to be probably disappointed about, given the strong rally that we've seen the last couple of days.
And speaking of the strong rally, particularly when it comes to the equity markets, I mentioned the S&P 500 up by some 9% in July. So do we continue to see this bear market rally, I guess, be chased?
Well, we think it probably is a bear market rally. Again, what we always have to remember is the markets are not the economy, and markets are driven by fundamentals, technicals and valuations. Now, on the technicals and the valuation side, it is very supportive at the moment, and that's why you're having this disconnect. But we do think the fundamentals will come back into play. We do see higher interest rates. We do see higher, inflation remaining sticky, and we therefore expect growth to be coming off, and that's not good. That's not good for risk assets.
Kirk, so if there is that disconnect, you forgot one thing, by the way. You forgot speculation as being one of the other ones. But you look at what's going on with the earnings season. How does that inform you of what's going on with the economy?
You raised two really important issues there, Rashad. The first one is sentiment. And you're absolutely right. And that's, again, what people like Fed Powell are trying to really be careful about. They don't want to be coming out there and being overly negative, and that's probably why they're saying we're at a neutral rate, because if your authorities are coming out as very negative, that will have a negative sentiment, and that will again obviously impact what's happening in the markets. In terms of earnings to date for the last quarter have probably come in a little bit stronger than expected, but then it was a relatively low bar. And so again, we would say it's going to be really what happens in Q3 and Q4 that counts. And certainly we're seeing earnings revisions on the downside globally. So it is, again, another reason just to be cautious.
And how does that then translate, I'm asking you, to the employment picture, which bizarrely, of course, if it is a technical recession, we don't have employment numbers like this?
Well, I'd put that more as they can be lagging indicators, Richard. But you are right. In the US in particular, households, in one case boosted still by the savings they were able to accumulate during the COVID lockdowns, and strong employment growth continues to really provide good support for that overall economy. However, once again, I think you'll start to see the numbers deteriorate in the months ahead. And again, they need to, because if they don't, we're going to still have inflationary pressures, and that will mean even higher interest rates.
Now, speaking of COVID lockdowns, that's very much impacting China's growth and therefore the overall global economy. We saw that bit of a shocker in terms of the official PMI. We're asking our MLive question today, how will this China slowdown really affect broader assets?
Juliet, you're absolutely right. The elephant in the room in China remains a COVID zero policy. And I don't think you're going to see any change in that in the near term. In fact, Xi Jinping came out late last week and once again reiterated how important the COVID zero policy was. And that's just incredibly hard to predict, incredibly hard. So that will continue to be a weight around the China market. And again, we are actually neutral China at the moment, because again, while we're concerned about the fundamentals, and a lot of that is driven by COVID, from a valuation and technical perspective, it's got strong support. So if you ask me, what do I think China looks like 12, 24 months out? Yep. I think it will look in a much better position, and that's why we're invested. Over the weeks ahead, it's very, very uncertain.
And uncertain too in terms of the global growth picture. I mean, we were a little disappointed from a lack of new stimulus announced last week by the Politburo as well. So all of that then factors into the global growth picture. What's your sort of outlook for that impeding, I guess, the impediment of global growth?
Well, you're absolutely right. In the period, that second largest economy, it's not going to get its 5.5% growth targets. It could even be less than 4%. So you're not going to have the support from China. And then in a lot of the other economies, you're having those rising interest rates and expecting that to be kind of impinging on growth. So it's not a rosy outlook.
Kirk, last question. Where does the dollar go and how does that affect how you advise people?
I expect in this environment of rising interest rates in the US, and we expect rates to peak higher in the US and other developed markets, the dollar will continue to be well supported. And again, the real kind of impact on that is in the emerging markets and in Asia, because that's going to be pushing the central banks in this part of the world, again, probably to raise interest rates to protect themselves from the inflationary pressures.